Square was our advisor, and DSK Legal was our legal advisors, and completed the legal DD for the companies. All this results in a very significant outcome for Strides shareholders, and considering that it is very important that we get the best outcomes for Strides shareholders, it's important that we take a few minutes to understand that better. One is that we have unlocked close to about 2,400 crores of equity value in soft gelatins, 100% of that staying with Strides shareholders. When it comes to Steriscience, the trading multiples are approximately 15% discounted to peers, and in the case of Stelis, based on the NPV model of our contracts in hand, we have announced that we now have close to about $600 million of sales contracts in Stelis, starting from 26 to 32, and we only see that book increasing. So based on a DCF methodology and different weightages both valuers and the fairness opinion makers have, we have secured a fairly reasonable valuation for Stelis too, although the company is just about in its break-even phase. Strides shareholders will get 44% of the economics of OneSource. This translates to approximately an implied value of 364 rupees per share of Strides. And I'm sure if you adjust for the Stelis multiples, because it's just a break-even company, but the fact that we have invested over $200 million in capabilities there, you will see that the incoming EBITDAs adjusted for Stelis is over 30%. Historically, our soft gelatin business delivers this kind of business. Historically, our injectables business has always delivered margins of these levels when we used to own and operate Agila. So we're delighted that we are creating a business adjusted for Stelis is already in the 30% of EBITDA with significant free cash generation. What this also does is that we bring debt to a very reasonable level in both our companies. About $35 million or 300 crores of debt gets pushed down from Strides to OneSource, reducing the debt to EBITDA ratios in Strides to about 2.5 times. And with free cash generation, we expect that to accelerate even further, going forward in the next 1 year. We are in Strides also guided as we would take away 500 crores of revenues from Strides and about 150 crores of EBITDA. We have taken the liberty of guiding long range, saying that our FY25 numbers will not be lower than what we do today, which effectively means 4,000 crores of sales and not less than 700 to 750 crores of EBITDA. I can err on the side of caution, on the side of optimism on revenues, but not on the margins. So with that, I think that we have solved for the challenges the group faced, which, as you would recall, went through difficulties for the first time in its history. But we all remember the blemishes, and we are delighted that we are now coming out stronger from this very difficult situation that we went through the last 2 years, especially during COVID. Promoters have invested close to about 1,000 crores about 850 crores between Stelis and the other companies that comes into this program, and consequently the shareholding of the promoters move up from 30% to 39%, which reflects the value of the capital that we have invested. We also have a very strong professional management. As you know that post Agila and our non-compete, we have most of our senior leadership back at the group, and we are delighted to have all of them running the new ship. And I'm sure that the new company will deliver significant value for our stakeholders. We expect this process in terms of an NCLT to be completed in approximately 12 to 15 months, given the nature of such transactions. And we hope that the net result of this would be an outstanding outcome for all our shareholders, both in the parent and the new core that is created out of this. This also brings to conclusion my own commitment to my significant stakeholders that not only will the family come back to run the business, but we'll stay invested, but also therefore it was very critical that we align our interests in the group. Now I must also be honest in saying that not all of our businesses have started to be aligned in the group, because if we do that, it will be very dilutive to Strides shareholders. But over time, as valuations increase for both these companies, we will always consider, subject to shareholder approvals and being reasonable, to combine all our interests under one factor. But at this time, we don't have any competing businesses with these two the platforms that we have created. And I'm happy we have reached here at this stage in a relatively quick time. And I will now, we have a very detailed deck which includes shareholding pattern, the contours of each of the businesses, what we are doing, and I can also tell you that we have a very strong H2 across the company, including this platform. So we're very confident of meeting both our guidances of the platform EBITDA and also the products company, which is Strides Pharma. Most importantly, I can also assure you that both the injectables business and the soft gelatin book is quite full for the next year. So we don't have to scramble for any new business to meet our guidance of $180 to $200 million. The reason why the range is 180 to 200 is more to do with Stelis, because it depends upon how quickly our partners get approvals. But we expect Stelis to add $5 to $6 million of EBITDA in FY25. But we have also guided in this document that we see this business doubling in 3 to 4 years, and that's mainly because of our leadership position in drug device combinations. We have now about 14 customers in our GLP-1 programs, and I'm also pleased to let you know that for many of the first-to-file players in the US and various other markets, we are their preferred or sometimes sole supplier. So we're excited to partner with our global partners. We've now added top 10 big pharma in our group as customers, and I'm excited to be extremely confident about where this CDMO will not only be differentiated, but a very different quality of business. The biologics works on a significantly higher gross margin and EBITDA, as is the case globally. What this also does for the benefit of our investors is that there are only two unique companies in the world which offers, of course they are much bigger and do a lot more than us, but the only two unique companies that offer soft gelatin capsules, biologics, injectables, and drug device combinations are Thermo Fisher, and which is the erstwhile Patheon part of Thermo Fisher, and also Catalent. Of course, Catalent has its own challenges, as all of us know, but I'm just giving these two names as comparison, as you will not have a peer comparison in the Indian ecosystem for CDMOs. I know this has been a slightly longish opening statement, and I'm sure you guys are getting used to it. Let me now hand over the line to Neeraj for him to make his introduction, and after that we'll open the house for questions. My colleague Badri, who's our group CFO, and I'm here, and along with Neeraj will address your queries. We are hoping that this meet will mainly address questions related to the deal that we have announced. Appreciate that. Thank you. Neeraj.
Yeah. Thank you, Arun. Hi, thank you everyone for listening in. So it's a real privilege for me to introduce myself and OneSource, which is, as Arun mentioned, going to be India's first specialty pharma CDMO. So a little bit about myself. I have spent 28 years building and running businesses globally across multiple geographies. I started with India, then moved to Southeast Asia, Latin America, and now in Europe, where I'm based for the last 17 years. In fact, the businesses which I have led have not only been across new regions and geographies, but also across all stages of evolution, starting up or scaling them up, turning around, and even post-merger integrations. So thus, with all this, I can say, a complete 360-degree view of the pharma value chain. Having spent large part of my 28 years with Ranbaxy and then with Sun, I joined Steady Science as its CEO about 2.5 years back, as Arun mentioned, to build our specialty injectables business. In fact, with a very strong legacy of Agila, its very formidable experience, expertise in sterile injectables, and most of the same exceptional team which built Agila, we have been building Steady Science as Agila 2.0 and building it at a breakneck speed, as you would expect from a company run by the group. This is a little bit about myself, and now about OneSource. So I personally have been always very keen to run a technology-led CDMO, and I strongly believe that pharma outsourcing to a specialized company like ours will continue its growth trajectory well into the next decade. In fact, that's why I'm hugely excited to lead India's first specialty pharma CDMO. OneSource will have as its growth engine two of the fastest growing trailblazers, as Arun already mentioned those. One is biologicals, and the second as GLP-1s, which, as you may know already, that's the new miracle therapy for diabetes and weight loss and so on as new things keep coming up with GLPs, where Stelis already has a significant presence, and we are set to emerge as a very dominant CDMO. Add to these the complex injectables and the high-tech soft gels, I think will make our complete offering immensely attractive to both our current as well as new customers. I would just like to talk now a little bit about the company. In some detail, Arun has mentioned many of these points, but I'll just give you a summary. So while the venture is new, its three individual parts, as you know, are already successfully operating, and we are set to deliver about anywhere between 140 to 150 million of revenue in the current year, FY24. And Arun also mentioned that thanks to some of the recently signed contracts which we have, including actual customer forecasts and a very strong large funnel, we see this business growing anywhere between 20 to 25% year on year over the next many years. We have significant number of customers already in place for our GLPs, with almost 350 million forecast of sales coming from them just for their first 3 years. And very strong margins, especially in these complex drug-device combinations, as well as the synergies coming from the merger of the three individual businesses, will drive our EBITDA from current about 25% to up to 35% in the next 2 to 3 years. And obviously, you know that we've got all our sites FDA approved, which will continue to open many more doors for us in the largest outsourcing market in the world, which is the US. So when it comes to our capacities, as you see, not only do we have currently some of the industry leading capacities in many areas, but as you all know, that we also have an unparalleled record of expanding capacities as and when these are needed. So just to close that, with our proven capability and large and dedicated team, OneSource is all set to be a specialty CDMO force to reckon with in this industry. Thank you very much. Over to Arun.
Thanks, Pankaj.
Neerav, we are good to open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask the question. Ladies and gentlemen, you may press star and 1 to ask the question. The first question is from the line of Abdul Qadir from ICICI Securities. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yeah. Hi. Thank you for this opportunity. So my first question is in terms of, when we talk about the different line of businesses, with the combined entity now, could you help us understand, what would be the contribution from a top-line perspective of all the three business units, and between biologics and chemistry, what would be the revenue contribution going up in the next 3-4 years?
So we are not giving a long-term guidance. We have given an FY24 guidance, which is there. The pro forma numbers are there in our deck, which is $145 million with 25% EBITDA. And we have guided that in FY25 this will grow to approximately $200 million with 30% EBITDA.
All right. Okay. And my second question is, if I look at the current revenues, that is FY23 revenues of the soft gelatins and steady sciences, so that ranges almost at between $30 to $40 million each. So this we expect that to go up to $60-65 million in the next year. So just wanted to understand if this would be a result of some inter-segment revenues, what strides have been sourcing from the new one source entity now, or this would be a normal course of business which is coming from some third-party customers?
No, so just to make corrections to your understanding, the $65 and $60 million that you're referring to are actually this financial year, right? And we are tracking to achieve those numbers without a problem. Okay, so we are guiding you and we are tracking those numbers without a problem. Now, these businesses in the soft gelatin business of $65 million, currently in FY24 will sit within the Strides numbers because the NCLT process will only be done in FY25 and the effective date is 1st April 2024. So there will be no change or no transfer of revenues from Strides into this until the company is formed. The growth for us is coming from new customers that we have added, including we just received a product approval which is like any CDMO, goes to one of the largest generic companies in the USA, which we announced on Friday. It is also a typical CDMO model. So new growth will come from those kind of programs that we have.
Sure. Thank you. And so would it be possible to share the...
Abdul, if you don't mind, come back on the queue. There are too many
questions. All right. Sure. Thank you.
Thank you. Next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Thanks for taking the question, Arun, and congratulations to the team for this transaction. Arun, on the GLP-1 contracts that you've referenced to a few times in the conversations, can you give us a little more color on by when do these businesses start, and are they all generic businesses we're talking about?
Yeah, obviously we are, currently all the GLPs are under patent, and they go off patents from 24, with critical patents getting off on the main drugs in 26 and from 26 to 32, and then the newer ones up to 37. But as a CDMO, we work on all the three products based on what our partners think are the opportunities for them to litigate, to fight patents, to win settlements. So we currently are working on all the three GLPs. So the combined GLP business, if I'm not mistaken now, is a little over 25-30 billion range and growing rapidly. But we do all the three GLPs because all of them are drug-device combinations, and we are very strong in drug-device combinations because we have got very solid investments in devices, and we are a leading drug device player globally, if I may.
And secondly, on the biologics business, obviously this business starting out, you've talked about the contract that you've signed up. But, if you take a slightly more 3-5 year view of the business qualitatively, how do you see this business evolving? And what strengths do we carry in this business?
So typically, from an MSA to a CSA, which is a commercial sales agreement, the process can be as low as 2 years to as high as 10 years. So you need an array of businesses, customers, and programs that ensures that we have, a very solid order book. In our case, we just got FDA approvals now for the plant, and most of the products are still under patent. So the capacity utilization moves up significantly only once we get these products commercial, which starts from 25 to some extent on some of the products like liraglutide, whereas the semaglutide, the Wegovy, and Ozempic, the patents in different countries have got a big range. But the fact of the matter is that there are not many players doing that. But we also, if you recall, announced in our last transaction that we have signed our largest biologics drug substance deal in the last quarter. So we continuously add contracts, but when the OpEx leverage flows through only when the CSAs, the commercial sales agreements, reach a high level of maturity, which will happen in the next 2 to 3 years. That is why we have guided in these documents today that we have no challenges in seeing this business doubling from the $200 million that we will do in FY25 when the scheme is completed in less than 3 to 4 years. And all of that will come from, or a lot of it will come from the growth in the biologics division. And that's why we also upped our EBITDA to 35% at that time, because the OpEx leverage is significantly higher in the biologics business.
No, thanks. I'll come back later.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir. Just few clarifications. So the valuation for Softgel as well as Steriscience is around 17 times FY24 EV/EBITDA. Is that the right number, sir?
Yeah, you're right.
Okay. In case of Steriscience, it's not a clean merger, and we see that 99% is getting demerged. So any reason why we did not pursue a complete merger?
So from what I know, it's a clean 100% demerger, merger into the scheme. I do not know what you're referring to, but I can check and come back to you.
Okay. And sir, is there any shareholding of Strides in Steriscience as of now?
Go to the slides that we have presented. It says that it already shows the cap tables.
Okay. And finally, on the guarantees which Strides has given to Stelis, so would we envisage that once these two companies are separate listed companies, there would not be any guarantee from Strides towards Stelis?
Well, that's the assumption. We obviously have to, all of this is subject to shareholders and lenders' consent, but that's the assumption, and that's the right thing to do too. I'm confident that we'll get that.
Understood, sir. Thank you and all the best.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Naitik Mahta from Sequent Investments. Please go ahead.
Sir, just one question from my end. So there's a bit of confusion. I would like some clarification. What is the valuation of Steriscience that we are assuming for the entire scheme?
Sorry, what is the confusion?
What is the valuation for Steriscience that we have assumed for the entire scheme?
Naitik, sorry to interrupt you, but your voice is not coming clear. Can you speak through the handset, please?
Yeah, so my question is, what is the valuation that we have assumed for the merger of Steriscience?
If you go to the valuation synopsis, all the valuations of all the companies are mentioned in slide 9. I'm sorry if the slides are not numbered. If you go to the valuation synopsis, you will see that the valuation is 2,195 crores.
Okay, sir. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Rohit Mundra, individual investor. Please go ahead.
Thank you for the opportunity, sir. In one of the slides you have mentioned our aim to grow the one source business to almost $180 to $200 million by FY25 with a 30% margin. So would we be requiring any capex investments to achieve the same?
No.
Okay. And my second question was relating to the working capital. So what was the working capital requirement for the one source entity, given the CDMO business is a quite working capital intensive business?
Well, the CDMO business is, you're right, it's both capital intensive, but it is not so much working capital intensive. So we expect the total debt to EBITDA to be around 2.25 times in FY25. Half of it will be working capital and half of it will be term debt.
Okay, good. Thanks, sir.
Thank you. Participants, you may press star and 1 to ask a question. Next follow-up question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Thanks. Just following on the previous question, at what stage do you envisage any large capital infusion required in for the one source business for the growth plan that we've envisaged?
So then in the business, as you would see from the numbers, it already delivers carved out and adjusted for Stelis, has got very significant ability to generate free cash. And in the CDMO business, at least in our model, a lot of the capex, especially in biologics, is partnered. The partner pays for most of it. So unless we are going to expand significant capacities, which we have to, especially in our drug device capabilities, we currently have only about 40 million devices that we can make. We probably need to double that or even more. But we don't need to do that now. We will do this closer to FY27. And we think the business will generate enough free cash to do that on its own. But it will not require equity infusion into the company unless we are making very significant plans. But as we see it now, we don't see any need for any new capital in the near term. I mean, not significant capital. There will be 200-300 crores of capital even in its first phase of growth. When we think we will be able to double our revenues from 200 to 400.
And secondly, when we taking this number of this total $400 million number for the one source business, obviously, the three main contributors as you highlighted would be the GLP-1 contracts, the soft gelatins as well as the injectable business. But what about, how do you see, what growth part do you see for the plain biologics business? They talk about the drug substance contract that you've signed up. But
drug substance, on the drug substance part, both in mammalian and microbial, especially mammalian, we just commissioned our facilities about 3 months ago, the 4,000 liter capacity. And we have ability to go to 8,000 liters in the same plant, and for which we already have equipment. So this is a business which is very nascent for us. So we would see a lot of the ramp up on the biologics to be closer to 2 to 3 years away. But the key to be successful CDMO is to sign new contracts, either new biologics, an NBE or a biosim. And that is what we are doing, and we have a nice funnel of customers who are keenly looking at us, especially now that we are FDA approved on our drug product. It has been quite easy to attract more customers. So the number of RFPs that we have issued have been quite significant in the last several months.
And growing in different markets.
And last one, with this sort of with this restructuring now, which is done in one source, I mean, how do you visualize the Strides business X of soft gelatins and X of one source, over qualitatively a 3 to 5 year period?
Well, Nitin, you've been following us for 15 years. We don't do 2 to 3 of you. We had to do this in one source simply to give because it's a completely new company and we wanted our investors to know the value of that business that we're creating. For FY25, we are saying that the 500 crore revenue and 150 crore EBITDA that we lose to OneSource and Strides will be 100% recouped, and there could be even growth from there. Beyond that, we should be able to get back to our historical growth, Nitin, which is typically now more focused on bottom line growth, as you can see from our numbers and our gross margin expansion. Not so much focused on top line growth, maybe 12 to 15% CAGR, but EBITDA CAGR, like I said in the last earnings call, will be significantly greater than that.
Thank you. Thanks, Arun. Best of luck.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Chetan from Pragya Equities. Please go ahead.
Yeah. I just wanted one clarification. In presentation, at one slide you wrote that Strides shareholders to participate in value discovery by holding 44% in OneSource. And another side, it shows that the shareholding post demerger will be 61%. So I'm a little bit confused.
Yeah, that is because that the 61% is the total public shareholding that includes all the shareholders of Strides. Because there are other shareholders in the other two companies, right, Chetan?
Yeah. Yeah.
Thank you.
Thank you.
Yeah.
Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Rahul Mangla, individual investor. Please go ahead.
Sir, actually, I want to ask a question like, there is a current debt of around 3,000 crores. So, how is the company going to plan to reduce this debt?
So, firstly, the announcements we made today solves for the debt to EBITDA ratio because you'll also appreciate that the combined EBITDA of the two companies are now 1,200 crores, close to that. So, the debt to EBITDA is a very comfortable situation to operate a company of this size and scale. We started off 18 months ago at 5 to 6 times run rate, and now we are in a very comfortable situation. There's enough free cash generation for logical debt reduction, but debt is not something we don't think there's an overhang of debt or something that we can't handle. We mentioned that in Strides, our working capital cycle times are long, given that our business in the U.S. has a long working capital cycle time. That is reducing significantly. And for the first time last quarter, we generated free cash. We expect that to be a phenomenon during the year. And I think in 2 to 3 years, you'll see us, if not free cash on the main company, relatively very marginal debt.
And thank you. And is there any plan for company for bringing the stock buyback program is done? Like other companies are going through that?
No, we don't have.
Thank you.
Thank you. Ladies and gentlemen, we'll take the last question from the line of Rahul Bora from Incred Capital. Please go ahead.
Yeah, hi Arun, Prafulya. Arun, can you just take us through the pipeline in each of your segments and the current portfolio? So, in the soft gel, injectables, and the biology.
Yeah, sure. So let's start with the biologics because we've done a lot of conversation around that. We don't have, in biologics, it's 100% CMO/CDMO. We do, the D part of our biologics business is more to do with work to help our partners to improve their yields or cell lines and stuff like that. We don't do much of the D because in the biologics, we anchor customers who have already done a lot of work. And then we are their CMC partner mainly because that's how the industry works. In the soft gelatin business, we have a very strong, we have, I would guess, portfolio, you know us for some time, 8 out of 10 approved products globally, we already have. The other 2 may not be material, But now being a CDMO, they become material because our expanse is now the world and not what we would look at the narrow eyes of what Strides would want in territories and markets it operates. We have a very strong pipeline. Our approval for icosapent is a good example. That was the only large soft gelatin product that was not in our pipeline, not in our approved list. We do have some very nice products. We are now expanding into the controlled substances and the oncology space in our New York facility because we have the ability to make those products. There are a few soft gelatins which requires containment, which we don't do in India. So that expansion will happen in the next close to about a year from now, but R&D for that is already happening. So I think by end of FY25, every single product that is approved would be in our pipeline in terms of partners or products. Steriscience is a legacy business. We have a very strong pipeline of approved products. We have about 14 ANDAs approved, and we are adding more and more products into that portfolio. We expect that business to grow. We are full up on capacities for this year and next year. So this merger will also allow us to expand capacities at Stelis because it's an FDA-approved site, and we already have space to add another line. Once we add another line, that will help double the Steriscience business in the next 3 to 4 years. This is a business we know very well, and it has always been a B2B business, a kind of a CDMO revenue share profit modeling. We were pioneers in that model. So we're just getting back to what we did earlier, better with less number of products, but more smarter products in the marketplace.
Sure. And just a clarification, Arun, the current soft gel business we do in Strides, is it a B2C business or a B2B business?
It's a combination, but more than half of it is B2B.
So once it gets shifted to the one source entity, where the structure is mostly for a CDMO and a B2B kind of a business, so does it change anything for us, or would it continue the way it is?
No, so Strides will Strides will be a partner for those products that it markets. But even those products, Praful, we don't have exclusivity. If you look at IMS on many of the soft gelatins, you will see market share 60 to 70% on our own IP with 2 or 3 players, and that's a standard practice that we've been doing for long. So we have much more market share than what you see in the IMS simply because of this model that we've been adopting for soft gels for a long period of time. And we just expanding capacities from 800 million to 2.2 billion units, and that will be commercial as early as end of this year. And I can also tell you that a large part of that expanded capacity is now being consumed by the RX OTC space, which we never used to operate earlier.
Thank you so much.
Thank you.
Thank you very much. And now hand the conference over to the management for closing comments.
Thank you. Thank you all. Really appreciate your time today. And as always, if you have questions, please reach out to our investor relations team or to Abhishek or any one of us, and we're more than happy to chat with you guys. Thank you all and have a good evening.
Thank you very much. On behalf of Strides Pharma Science Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.